Are you starting out as an investor? It must be pretty exciting looking for stocks you want to invest in. You hear people from different walks of life talk about having 10, 20, 30, or more stocks in their portfolio. Yet you wonder for yourself how many stocks you should invest in. Well, Warren Buffett also encountered a similar situation as well. In this video, you will learn the rules of thumb that you can apply to identify how many stocks you should invest in according to the Oracle of Omaha himself. Welcome to EM3 Financial Freedom Strategies, where you learn how to manage your time and money to achieve financial freedom. If you want to know all the essential details that can help you keep yourself up to date about finances, wealth, and investments, then make sure to watch until the very end. Investors have been plagued by the question of how many equities they need in their portfolio to achieve their financial aims since long ago. Luckily, there are wealthy people out there, such as Warren Buffett, who gave us a valuable example regarding this matter. So, how was Warren Buffett when he first started out? Let's compare Warren Buffett's present portfolio to the number of equities he had during the start of his investment career. 11-year-old Warren Buffett made his first stock investment in 1941. For a total of $114, he purchased 3 preferred shares from a business named City Service. He very much went all in because his current net worth was just over $100. But when Buffett was 19 years old, he would have a change of heart. He studied The Intelligent Investor at this time and then attended Columbia Business School to study value investing with Benjamin Graham. Buffett increased his diversification to 7 stocks after thinking that a single stock isn't enough. In the 1950s, Buffett formed a partnership with several other investors, which eventually became the investment vehicle through which he would make many of his early investments. Throughout the 1970s and 1980s, Buffett continued to make investments in a wide variety of companies, including American Express, the Washington Post Company, and Coca-Cola. He also began making investments in the insurance industry, through which he would eventually build Berkshire Hathaway into a conglomerate with holdings in numerous industries. In the 1990s and 2000s, Buffett continued to make investments in well-known companies such as Wells Fargo, Geico, and Dairy Queen. In recent years, Buffett has continued to make investments in well-known companies such as Amazon and Bank of America. Additionally, Berkshire Hathaway has made large investments in the energy sector and other industries. Looking at his timeline, with only very few in the beginning, he now invested in numerous companies down the line. This leads us to believe that Buffett likes to maintain his attention on select investments back then. We wouldn't see the same scene though if we skipped ahead to the present. More than 40 publicly traded firms and more than 50 functioning affiliates are owned by Warren Buffett. Does this imply that Buffett now prefers a portfolio ranging from 50 and above companies rather than just a few? That as time went by in his career, he no longer prefers to limit his portfolio. While it may appear that Buffett has a lot of stocks in his portfolio, it's important to note that most of the stocks he holds are in companies in which he has a significant stake in. Take note as well of the kind of money he operates with. It's not just $100 or so. With this, he said, "We'll never get a chance to do that working with the kinds of money that Berkshire does. We try to load up on things, and there will be markets when we get a chance to from time to time, but very seldom do we get to buy as much of any good idea as we would like to." Buffett would enjoy managing a focused portfolio right now as well. It's only that when he exclusively considers the business world's big shots, he hardly ever discovers one of them to be both understandable and cheap. Luckily for us, we aren't limited by these big shots. Now that we're at this point, what does Warren have to say for all of us who are looking to invest in more stocks? Here are his 4 rules of thumb. Number 1. Are you investing in risky stocks? As per Warren Buffett, risk with us, well, it relates to several possibilities. One is the risk of permanent capital loss. And then the other risk is just an inadequate return on the kind of capital we put in. It does not relate to volatility at all. You will pretty much need more diversification the riskier things get. Of course, you can't put your money on similar businesses or else you risk losing all your money. For example, you put your money into 20 different companies that are solely working on keypad phones. Won't they all similarly decline once a touchscreen cell phone comes into the scene? Number 2. Are you an investor who knows what he or she is doing? A know-something investor is someone who has specialized knowledge or expertise in a particular industry or market. They use this knowledge to make informed investment decisions and to identify undervalued companies with strong fundamentals and growth potential. This type of investor is different from a know-nothing investor who makes investment decisions based on broad market trends or other general factors rather than on specific industry or company knowledge. For instance, Warren Buffett is often referred to as a know-something investor, as he is known for his deep understanding of the companies he invests in. To this, he said, "Diversification is a protection against ignorance." I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks, probably. You don't need much diversification when your understanding of certain businesses increases. Conversely, it is preferable to buy a variety of assets, perhaps through an index fund, if you don't know where to look at. Number 3. Are you able to earn them all back? The less capital you have, the fewer stocks you must go. As per Warren, you will see things. If you're working with smaller sums, it would be a mistake not to have half your net worth in. For instance, if you just had a few weeks' pay to invest, you might as well stake it all in one stock. When we begin discussing large quantities of money that require several years to earn back, then it's time to think about diversification. Number 4. Are there opportunities much better than others? Buffett does not understand investors who choose to put their money on the second best rather than the number 1. With this, he remarked, "And to have some super wonderful businesses and then put money in number 30 or 35 on your list of attractiveness and forgo putting more money into number 1 just strikes me and Charlie as madness." This strategy allows him to avoid competitive situations where he could potentially lose a significant amount of money if the company he is invested in faces stiff competition from its rivals. Well, that is all for this video. As always, we in EM3 wish you the best of luck. We hope you enjoyed watching this video and don't forget to give a thumbs up if you liked it. Please subscribe if you haven't done so, especially if you're looking for tips, ideas, and other related information that can help you achieve financial freedom, stability, and independence. Thank you for watching and see you in the next video.